We're going to talk about the concept of market efficiency, what are the factors that affect it, including trading costs. We talk about the three different forms of market efficiency, what are the implications of the hypothesis that says market is efficient, and there are some anomalies that fall outside this hypothesis. We'll look at the two different types, which is time series and cross-sectional. We'll look at some other anomalies and what are the implications of these anomalies and what is the link of behavioral finance with these anomalies. So let's get started. First of all, what is the market efficiency concept? See, if the market price of a stock is equal to its intrinsic value, and what is the intrinsic value? It is the present value of future cash flows, right? And if the market price is equal to the present value of future cash flows, then in very many ways, the market is efficient because it is pricing the stocks or the assets as per their value, right? Now, for that to happen, the market participants should have enough ability to come up with an accurate projection of the future cash flows and have the ability to discount them back to today and appropriately then buy or sell stocks or securities to bring them to that price. If that does happen, yeah, the market, you can say, is quite efficient. If, however, that doesn't happen, let's say the present value of the future cash flows of a particular stock is $200, but that stock is in the market for $100, well, you can buy it at 100 and sell it at 200 once everybody else realizes what the future cash flows are. So if the market prices do not fully incorporate the information, then opportunities exist to make abnormal profits. Now, that information that we are talking about is public information, right? The future cash flows that we're talking about that somebody is using to come up with this $200 present value is public information which they are gathering from the financial reports and other public data of that company. We're not talking about private information over here. Obviously, if nobody else knows and there is some private information that this individual is using to come up with this $200 intrinsic value and then making this extraordinary profit, then yes, the market is efficient, but it is strong form efficient. So what you will learn over here in this learning module, that there are three types of market efficiency levels or forms. There is weak form, there is semi-strong form, and there is strong form. Now, in a strong form efficient market, which evidence says does not exist, even private information is priced into the market. That's not possible, right? Why that's not possible? Because it would be illegal for people to use private information to come up with the free cash flow projection and then come up with the intrinsic value and buy stocks and push them up to that price, right? That's insider trading. That's not allowed. So what we are saying that majority of the world's bigger markets like New York Stock Exchange are semi-strong form efficient, which means the financial reports which are public, right? The financial material information that is public is already priced in. So based on public financial information, there is certain projected financial cash flows and the present value of that is what the market price is reflecting. So that is a semi-strong form. Now, if that is not happening and there is a possibility to make extraordinary return, abnormal profits, then the market is not semi-strong form, it is weak form efficient, right? Where one can take these financial reports, public financial reports, and make extraordinary returns. There is something even weaker than weak form. And in that situation, you don't even need to take the financial reports and come up with a present value to make extraordinary return. In something which is even less than the weak form, what you can do is, let's say there is a stock and there is a certain, let's say, average price of that stock. Whenever that stock is going above its average, people are selling it. Whenever it's coming below, people are buying it. And similarly, you don't even need, it's not rocket science, right? It's just a simple moving average, which we call technical analysis. right? It's one example of technical analysis, that you just look at a moving average and you buy and sell based on that. And that moving average could be not necessarily in a straight line. It could be like this as well, that there might be a trending stock, but you could again sell it here, buy it here, and you don't even need to read financial reports for that. So if people are able to make extraordinary abnormal profits just by using technical analysis, then we say the market is not even weak form efficient. In a weak form efficient market, you cannot use technical analysis, but you can, however, use financial information, or what we call fundamental analysis. What is fundamental analysis? It is taking public financial information and then doing your present value of future cash flow, intrinsic valuation, and then trying to make extraordinary money. But if you can't do that, then that means the market is now semi-strong form efficient, where market prices are reflecting all available known public information. Yes, you can use private information to make money in a semi-strong, but that would be illegal. That's why the markets never go to strong form, because strong form says even private information is incorporated in the prices, but that doesn't happen because private information cannot be incorporated in the prices because it is illegal, right? So as a regulator, as a government, what we want ideally is semi-strong. That's the best we can achieve, and that's why they try to improve market efficiency, and we'll talk about how they do that and how that then leads into economic growth, because it basically creates a fair system for everyone, right? Nobody has an extraordinary advantage, right? So as discussed, what is the concept of market efficiency? The asset prices should reflect new information. The only reason why prices should react should be because something unexpected has happened. So when we say they should reflect new information, even future information which is not there but which is expected, right? So as far as information is coming even in the future which is as per the expectations, there shouldn't be much movement in the asset price. It's that when something unexpected comes, only then there should be a significant move, and even then that move should be very, very quick. So there shouldn't be much time that is there for somebody to make extraordinary profit. And what is the implication of all of this? The implication of all of this is that even if something new comes around, you're not going to get a chance to buy and make extraordinary profit on that. So the best bet you have is just buy and hold from before, right? And as the market goes up, you make money like everybody else does. That's the implication of the efficient market hypothesis. Why am I emphasizing on the word hypothesis? Because this is a theory. Are markets efficient? For the most part, yes, but not 100%. Even when we say New York Stock Exchange is semi-strong form efficient, that is not 100% true. And as you will see that there are certain situations when this doesn't hold true, and those are called anomalies, and those are the anomalies we're going to discuss: time series, cross-sectional, and other anomalies, and why these anomalies exist, right? What is the reason, psychological, emotional reasons regarding people's behavior that create these anomalies? So markets are efficient for the most part, right, but not 100%. So what an efficient market would mean is that the market value is equal to the intrinsic value based on all. If it's based on even private information, then that will be strong form. That doesn't exist. If all public information is incorporated, that means semi-strong form, right? And if only past market data, such as price and volume data, that if this is the average price, every time it's going up. So then what happens is that if that doesn't happen, and these movements are then along the average, and there's not much room for you to make extraordinary profit, because whenever it goes up above its average, people start selling very quickly and people start buying very quickly. So it never really gives you that extraordinary opportunity to make abnormal profits, right? So that would be even worse off than if it's happening like this. That means it's weak form. It's not even weak form efficient, that you can make money just by using technical analysis. If it doesn't give you the opportunity to make money using technical analysis, we say it's weak form efficient. If it doesn't even give you the opportunity to use fundamental analysis, then it's semi-strong form efficient. And of course, if even private information is priced in to the market value, right, then that's strong form efficient, but that doesn't exist. Now, what are the factors that improve the efficiency and what are the factors that stop the efficiency. So what do you think? Number of participants, definitely higher the number of participants, the better the efficiency, because when there are less number of participants, there's more room for market manipulation, right? Few big players can manipulate the market easily, but if there are a lot of players, then it's difficult for manipulation. Information should be easily available to everybody. Financial companies should disclose information which is relevant, and so that everybody has the same information and enough information, and there should be no limits to trading, as less limits as possible, right? So no circuit breakers ideally, which put a limit on how high the stock can go or how low it can go. So we should have as free a market as possible. The transactions cost should be as low as possible, and the information acquisition cost should be as low as possible as well. Only then the efficiency will increase, right? So now coming to the forms of market efficiency, weak form includes past market data. Now market data means what? Price and volume. What happens in a market? Trading happens, and that tells you what price it's happening at and what is the amount of volume of the transaction, right? So if that is already priced into the stocks or the security prices, well, you can't use that to make extraordinary money, can you? Because market prices already reflect the price market data. However, in a weak form, you can still use public financial information because that's not priced in yet, and you can still use private because that's not priced in either. In a semi-strong, however, the financial information gets priced in, so you cannot make extraordinary returns by doing fundamental analysis either. However, you can still do insider trading and make money, but then of course the law is going to then deal with somebody like that. So that's why you never really see that we get to strong form, because market prices can never reflect private information because we are not allowed to use private information to trade, right? So evidence suggests that in reality, the markets never really get to strong form, and to be honest, they don't never even get to semi-strong, because there are always possibilities of earning abnormal returns, and this challenges this hypothesis of efficient market. Now, it's not like the markets are completely inefficient. For the most part, I would say developed markets like New York Stock Exchange are semi-strong form, but if let's say if there's 10,000 stocks, then maybe 5% of those stocks are not having a market price. The market price is not reflecting all available public information. So there is obviously that possibility of stock picking. Otherwise, the whole industry of active management or stock picking wouldn't really exist now, would it? So in a weak form, what happens? They reflect all past market data. You cannot use technical analysis to make extraordinary returns, and technical analysis is not going to work to make extraordinary returns in a weak form efficient market. This is what the hypothesis says. Reality is, of course, technical analysts do make money, and rather they actually help keep the market stay weak form efficient because they keep buying whenever it goes down and selling whenever it goes up. Semi-strong says that you cannot make extraordinary return using publicly known material information, right? And what's the reality? Yeah, for the most part, market prices do reflect intrinsic values based on public information, but sometimes they don't. But even if there is some difference, then prices quickly adjust, and fundamental analysts help keep the market semi-strong form efficient, right? So markets are semi-strong form efficient for the developed markets, such as New York Stock Exchange. Now, strong form efficient would say that even private information is included in the market prices, but that, of course, is something that doesn't exist. And therefore, what we have evidence proving to us that markets are not strong form efficient, and the reason for that is because your government doesn't allow you to use insider information or private information, right? So technical analysts help keep your markets weak form efficient, whereas your fundamental analysts help keep your markets semi-strong form efficient, and your regulations prevent you from having a market reach strong form efficiency because private information is not allowed to be used in trading, right? And therefore, the role of portfolio managers is not to beat the market, but to have consistent returns for their objectives. And what we are seeing is a huge increase in passive investment, such as buy and hold, where a portfolio manager managing something like an SPY ETF, their job is only to track S&P 500, right? Not to actively outperform it. So huge increase in the passive industry based on the efficient market hypothesis. But the active industry still exists. It's becoming smaller and smaller, but it does still exist because the markets, even if they are strong form, are not 100% strong form, right? So there is evidence that there are anomalies. And we will talk about the anomalies, but we will take a break first. Let's get fresh and then jump into the anomalies after that.